Real estate is defined as land including the air above the earth below, plus any permanent improvements to the land such as homes, apartment buildings, factories, hotels, shopping centers, or any other real property. Whether for commercial or residential property, particularly all real estate transactions today involve some type of financing. The mortgage loan is the most popular method of financing real estate purchases. A mortgage is any loan in which the property is used as security for a debt. During the term of the loan, the property becomes security or collateral for the lender, sufficient to ensure recovery of the amount loaned. Mortgages today fall into three categories: FHA-insured, VA-guaranteed, and conventional. The National Housing Act of 1934 created the Federal Housing Administration, FHA, to encourage reluctant lenders to invest their money in the mortgage market, thereby stimulating the depressed construction industry. Today, the FHA is a government agency within the Department of Housing and Urban Development known as HUD. The FHA insures private mortgage loans made by approved lenders. In 1944, the Servicemen's Readjustment Act, the GI Bill of Rights, was passed to help returning World War II veterans purchase homes. Special mortgages were established, known as Veterans Affairs VA mortgages or GI loans. Under this and subsequent legislation, the government guarantees payment of a mortgage loan made by a private lender to a veteran or buyer should the veteran be in default of the loan. VA loans may be used by eligible veterans, surviving spouses, and active service members to buy, construct, or refinance homes, farm residences, or condominiums. Down payments by veterans are not required but are left to the discretion of lenders, whereas FHA and conventional loans require a down payment from all buyers. Conventional loans are made by private lenders and generally have higher interest rates than either FHA or VA loans. Most conventional lenders are restricted to loaning 80% of the appraised value of a property, thus requiring a 20% down payment. If the borrower agrees to pay the premium for private mortgage insurance known as PMI, the conventional lender can lend up to 95% of the appraised value of the property. Historically, high interest rates in the early 1980s caused mortgage payments to skyrocket beyond the financial reach of average home buyers. To revitalize the slumping mortgage industry, the adjustable rate mortgage, or ARM, was created. These are mortgage loans under which the interest rate is periodically adjusted to more closely coincide with changing economic conditions. ARMs are very attractive, particularly to first-time buyers, because a low teaser rate may be offered for the first few years and then adjusted upward to a higher rate later in the loan. Today, the adjustable rate mortgage has become the most widely accepted option to the traditional 15 and 30-year fixed-rate mortgages. Extra charges known as mortgage discount points are frequently added to the cost of a loan as a rate adjustment factor. This allows lenders to increase their yield without showing an increase in the mortgage interest rate. Each discount point is equal to 1% of the amount of the loan. By their nature, mortgage loans involve large amounts of money and long periods of time. Consequently, the monthly payments and the amount of interest paid over the years can be considerable.